Inflation is about to collapse the global economy, the Fed cannot stop it, and gold are going to go to $7,000 an ounce. That is the latest warning from Professor Steve Hanke, one of the most respected applied economists alive, in his latest interview. If you do not know who Hanke is, you need to. He is Professor of Applied Economics at Johns Hopkins University. He served on President Reagan's Council of Economic Advisors. He is the creator of the Hanke Annual Misery Index. He co-authored a viral Fortune magazine article with former US Comptroller General Dave Walker exposing the insolvency of the US government, and he just published an op-ed in the Wall Street Journal alongside his new book Making Money Work, which directly challenges the Federal Reserve's understanding of how inflation actually works. In this interview, he explains why inflation just jumped from 2.4 to 3.3% and why it has nothing to do with oil. He warns that commercial bank lending is accelerating towards dangerous levels, that bank deregulation is about to pour even more fuel on the fire, that AI productivity claims are Silly Valley hype, and that gold is heading for $6,000 to $7,000 an ounce. He also makes the case that we are entering a new commodity supercycle, and before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you are getting value from the videos, hit that subscribe button. It is free, it supports the channel, and you can always change your mind later. Now here is exactly what he said.
Not going to get the inflation genie back in the bottle, because already the loans being extended by banks are growing. They've been accelerating, and they've been now growing at almost 7% per annum. The rate consistent with hitting my inflation, the Fed's inflation target of 2%, is about 6%. So they're already elevated, accelerating and elevated. And those loans are very important, Jeremy, because most people don't realize that the money supply is not really a Fed thing. It's a commercial bank thing. Commercial banks produce about 80% of the money broadly measured in the United States, as well as Canada and virtually every other country around the world. Around 80%, the big chunk comes from commercial banks. The headline CPI jumped from 2.4% to 3.3% from February to March. That didn't surprise me because I saw the acceleration coming for the last 18 months in the money supply, and I looked at the 3-month annualized inflation rate in February in the United States. It was exactly 3.3%. None of this surprised me. The basis for my thinking is a quantity theory of money. It's all about what changes in the money supply. It's not changes in the oil prices, by the way, or commodity prices, or any particular price. Those are relative price changes. The best example is if you look at precisely 1979 in Japan. Japan, of course, doesn't produce any oil. We had an oil crisis in 79. And what happened, the inflation rate actually went down from 4.1% to 3.7%. Well, why did it go down? Because starting in 1974, the Bank of Japan decided it was going to squeeze the money supply and reduce its rate of growth, which it did. So oil prices boomed in 1979, but inflation actually went down in Japan because prior to 1979, they'd been squeezing the money supply, slowing it down, and that was feeding through with the traditional lags into the CPI. Most people just are completely confused about the causation related to oil and inflation. Every single article you read is going to say, oh, inflation went up in the United States. It jumped up to 3.3% from 2.4 because of the oil price increase. No, 10%, which I think they might, by the way, in the United States. Because of two things. The banks had very strong earnings, so their capital is going up. That means their firepower. That means, in short, a loosening of monetary policy. When bank earnings go up and their capital goes up and their reserves go up, that in effect is saying looseness is in the cards. The other thing that can affect bank lending are the regulations that are imposed on banks, because if bank regulations are tight and squeezing the reserves that they have.
So there is Professor Hanke explaining why almost every analyst on television is getting the inflation story backwards. They see oil go up and they say that is why inflation spiked. Hanke says no, oil is a relative price change. Inflation is always and everywhere a monetary phenomenon, and the money supply in the United States has been accelerating for 18 months. He proves it with a natural experiment from Japan in 1979. Oil spiked. Japan imports nearly all of its oil, and yet inflation went down because the Bank of Japan had been squeezing the money supply. That single data point demolishes the mainstream narrative, and it tells you exactly where to look for what is coming next, which is commercial bank lending. And the lending data is alarming. Bank credit is growing at nearly 7% year on year, above Hanke's golden growth rate of 6%, the rate consistent with hitting the 2% inflation target. Bank earnings just came in huge, which increases bank capital, which frees up reserves, which gives banks even more capacity to lend. And on top of that, the administration is actively deregulating banks, which frees up even more reserves. Hanke is warning that bank lending could accelerate towards 10%. That would be a monetary loosening cycle happening in plain sight while the Fed sits there doing nothing about it. The broader macro data is confirming the stress. The S&P 500 is down 4% on the year. All three major indices have broken below their 200-day moving averages. Moody's Analytics puts the probability of a US recession at nearly 49%. Goldman Sachs has it at 30%. The economy grew at just 0.7% in Q4 2025. February payrolls contracted by 92,000 jobs. On the national debt, the numbers keep getting worse. $39 trillion and climbing by $1 trillion every 6 months. Hanke and former Comptroller General Dave Walker published research in Fortune showing $6 trillion in government assets against $136 trillion in total liabilities when Social Security and Medicare are included. And the bond market is starting to reject US debt. The 10-year Treasury yield just hit 4.4%, the highest since last July. The 30-year is approaching 5%. Treasury auctions have drawn weak demand while $10 trillion needs to be rolled over in the next 12 months. On the consumer, the University of Michigan Consumer Sentiment Index just hit an all-time 70-year low. 86% of Americans say gas prices are their top financial concern. Gas has crossed $4.16 nationally. In California, it is approaching $6. In Los Angeles, $7 a gallon. Deloitte says the bottom half of the economy is effectively already in recession. Now, Hanke takes on one of the most popular narratives in the market right now, the idea that AI will be deflationary and will save us from all of this. And he does not hold back.
This is a narrative that's coming out of Silly Valley, otherwise known as Silicon Valley. This is the hype, the AI hype kind of thing. And number one, it hasn't happened yet because productivity actually went down in the United States in 2025. Not only GDP went down a little bit, but productivity also went down. So if AI is, the greatest thing since sliced bread, it just hasn't happened yet. I don't buy the Silly Valley productivity argument because they claim that it's going to be orders of magnitude. The potential growth rate in the United States would jump from 2 or 2.5% where it's at now to like 5 or 6%. There's just no way. It's not going to happen. To cut the legs out from under them right away, their productivity narrative boom is not going to happen anywhere near the magnitudes that they're talking about, is what Elon Musk and most of them have been proposing, by the way, which is a very bad idea. And that is a permanent income. They say, don't worry about AI. If you lose your job, the government's going to give you a permanent income. It's going to put you on the dole permanently. A terrible idea, but Musk is peddling this, as well as all these billionaires from Silicon Valley are peddling this idea. And the reason they're doing this is to get the public off their back, to keep the AI investment hype going and the AI investment boom going. And, they're raising capital and all kinds of new startups and all that stuff. Somebody asked me the other day, they said, well, has this ever been tried before on a large scale? And I says, yeah, all you have to do is look at Europe. In some place like France, where they have over 57% of the GDP being accounted for by government expenditures, what do they have? De facto, they have a permanent income. It's the welfare state. It's the welfare state morphing into this permanent income thing. There's a big difference between the Silicon Valley rhetoric and reality.
Somebody's selling stock, somebody's selling stock.
Somebody's peddling stock, and they do a pretty good job of that, by the way.
Yeah.
So there is Hanke tearing apart the AI deflation narrative that has been propping up tech valuations for the last 2 years. Productivity did not go up in 2025. It went down. The greatest thing since sliced bread, as Hanke Hanke puts it, has not shown up in a single macro data point. And the people pushing the narrative hardest are the same people who need to keep raising capital to fund their companies. And it gets worse. The Silicon Valley billionaires pushing AI are simultaneously pushing universal basic income, which Hanke calls a fundamentally socialist policy. They are telling the public not to worry about losing their jobs to AI because the government will give them a permanent income. France already runs that system. Over 57% of GDP is government spending. And the result is not abundance, it is stagnation. Meanwhile, the real economy is deteriorating. Commercial real estate delinquency rates on CMBS office loans hit 12.34% in January 2026, the worst ever recorded and worse than the 2008 financial crisis. $930 billion in commercial real estate debt is maturing this year. A 50-story tower in Manhattan defaulted in January. In Denver, office vacancy is above 36%. On private credit, Apollo and Ares have both capped investor withdrawals at 5% after facing redemption requests above 11%. JP Morgan has started pulling credit lines. The private credit market has ballooned to over $3 trillion on opaque balance sheets. Rick Rule, who personally runs a bank, has compared the high-yield ETF market to the CDO market before 2008, warning of a potential run on the bank with no FDIC backstop. On housing, Redfin reported 630,000 more sellers than buyers last month, the largest gap on record. Pending home sales hit a record low. Homes are 30% overvalued. The Shiller-Cape ratio on the S&P 500 is near 40, the second highest ever recorded. The Buffett indicator is at 213%, the highest on record. And on the oil shock that Hanke says is irrelevant to inflation but devastating to the real economy through demand destruction, the dated Brent price hit $144, the highest ever recorded. Gas above $4.16 nationally. Diesel forecast to peak above $5.80 this month. A third of the world's fertilizer supply cut off, meaning a food price shock is coming on top of the energy shock. This is the backdrop against which Hanke is making his call on gold, on commodities, and on the death of the bond bull market. Here is where he lands.
I think the secular bull market is intact. We got some consolidation around a little below 5,000 going on now for a while, which doesn't bother me because it means that contracts are in stronger hands. But I think the market will peak out, the bull will peak out around $6,000 to $7,000 an ounce. And if you look at the current situation, the calls outnumber the puts for the May gold contract by about 4.5 to 1. So that's a bullish signal.
Right.
The options market thinks it's going up. You want to be long all commodities now because I think we are entering a super cycle again with the commodities. So it's not only the precious metals. Ferrovanadium, it's up 90%. Molybdenum up 25%. Lithium carbonate up 39%. Lithium hydroxide up 49%. Lithium spodumene up 52%. Tantalum, huge spike. 133% since December. Niobium, 28% up. Aluminum, 22% up. Tin, 21%. Steel, 16%. So you have all of these things happening, and what you'll see more spikes occurring, and that's typical of a super cycle. They call it pivoting away from the tech stocks into halo, heavy assets, low obsolescence. You want to be halo because people are hoarding commodities now. And this comes into the Gulf. What's happening in the Persian Gulf and the Strait of Hormuz? People are going, oh, we really should have more inventory of these things. In Asia, the average storage inventories was only 30 days. So they pickle when the war broke out. So maybe they'll want to be hoarding, inventorying more. Helium, sulfur, oil, fertilizer, all these things. If you think there's a risk that you haven't attended to, you want to have a precautionary inventory. I think we're set up for another super cycle because there will be an augmented demand just for precautionary inventories across the board. I think those yields will go up as inflation goes up, and you don't want to be long bonds. bonds. You don't want to be long the 10-year. I'd be out of there. That's my message on bonds. One of the longest bull markets in history has been the bond market from starting in 1980 until just a couple years ago, but it broke down and it no longer exists. We are not in the huge secular bull market in bonds anymore. And I think right now, for at least the short term or intermediate term, you don't want to be long bonds.
So there is Professor Hanke laying out the full picture, and his conclusion cuts against almost everything you are hearing on mainstream financial television right now. Inflation is not being caused by oil. It is being caused by money supply growth that has been accelerating for 18 months and is about to accelerate further as bank earnings grow, bank capital expands, and deregulation frees up even more lending capacity. The Fed does not even look at money supply changes. They do not believe it matters. And Hanke says that is exactly why they're going to fail to contain what is coming. The AI deflation narrative is, in Hanke's words, silly valley hype. Productivity went down in 2025, not up. The Silicon Valley billionaires pushing this narrative are simultaneously pushing universal basic income, which Hanke calls fundamentally socialist. And the reason they are doing it is to keep the investment boom going and the capital flowing into their companies. Somebody is selling stock. Meanwhile, the bond bull market that ran for over 40 years from 1980 to the early 2020s is over. Hanke says get out of long duration bonds. Yields are going higher as inflation accelerates. And the place to be is halo, heavy assets, low obsolescence, commodities. Physical gold heading for $6,000 to $7,000. The options market agrees, with calls outnumbering puts 4.5 to 1. And beneath all of that, the commodity supercycle is already in motion. Ferrovanadium up 90%, tantalum up 133%, lithium up 50%, aluminium, tin, steel, all rising. Asia had only 30 days of commodity storage when the war broke out. The world is now scrambling to build precautionary inventories of everything, from helium to fertilizer to oil. And that structural demand shift is not going away even if peace breaks out tomorrow. Gold above $4,650, silver above $75, oil at record physical delivery prices, inflation at 3.3% and climbing, the 40-year bond bull market dead. AI productivity gains invisible in the data, the Fed ignoring money supply, and commercial bank lending accelerating towards levels that guarantee more inflation, not less. The question is no longer whether inflation is coming back. The question is whether anyone in a position of power understands why and whether they will act before it is too late. Stay informed, stay prepared, and make sure you are subscribed because we are tracking every development as this unfolds.